the recording. So, sir, please, when you are done, you just
Okay.
click on end meeting. Hello, sir.
Hello?
Yes, I've started the recording. So when you are done, just click on end meeting. The recording will stop.
Okay. Chapter 1.
Yeah.
This is the
All right, let's proceed.
introductory class, and we are looking at chapter 1. That's financial management functions. And for today, we're expected to cover the nature and purpose of financial management, the learning outcome, the learning objective. We're in chapter 1, the nature of financial management, down up to measuring achievements. Are you there? The nature and purpose of financial management. Financial management refers to that aspect of management which involves planning and controlling the financial affairs of an organization to ensure that the organization achieves its objectives. We already know that every organization has their objectives, their aim. Of course, you must have heard of the vision and mission of every organization. So financial management deals with that aspect of management that involves the planning and controlling the financial affairs of the organization. Of course, I'm sure we all know what the financial affairs are, the monetary aspect, because in accounting, whatever we do has to be translated to monetary values. Otherwise, it may now involve some other aspects. So this involves decision about how much finance the business needs for its daily operations and longer-term investment projects. It also involves where the finance should be obtained. Where are we going to get that finance? Are we going to use equity? Are we going to approach the bank? Are we going to use any other source of fund? Maybe we invite the public. So how do we manage the short-term cash surpluses and deficits? Of course, we must have heard of cash flow. The essence of cash flow is to know when there will be surplus and when there will be deficit and what to do about it. See how much to be paid as dividend, that's at the end of the period in question. How much do we pay to the owners of the business, to the investors, and how to protect the organization against financial risks. Financial risks, which is very important. We'll explain on that later. 1.3, financial management accounting, and financial accounting. We've heard of the three terms: management accounting, financial accounting, and then financial management. What's the relationship, or what are they? Financial management should be distinguished from other financial roles, as financial accounting is primarily concerned with preparing financial statements for shareholders and external users. It provides financial information about historical results, past plans, and decisions. Hello, can you still hear me?
Yeah, we can hear you, sir.
Hello? All right.
We can
hear you.
All right. Financial accounting, as we know, is mainly historical, what has happened in the past. But what is management accounting? The management accounting is concerned with providing information for daily control functions and decision-making for internal users. It provides both financial and non-financial information to assist management in planning and controlling the resources of the organization. Its focus is internal reporting. So while the financial accounting is primarily for external financial reporting, management accounting is about internal reporting. Now, how does financial management come in? Financial management is primarily focused on managing the organization's finance. That is raising finance and ensuring the finance is efficiently and effectively used. Ensuring that the finance is efficiently and effectively used. It focuses on raising finance and effective allocation of resources. It assists both internal and external users. So I hope we can get it now. While financial accounting is for external reporting, financial reporting, management accounting is for internal, but financial management is for both internal and external users. So what's the relationship between these three terms? Though financial accounting, management accounting, and financial management are different, there are some common principles adopted by them in providing information to the different users, such as the ratio analysis of the report provided by financial accounting. It's used by financial management to advise investors on the viability of organization. I hope you have heard of ratio analysis before. Have we heard of ratio analysis before? Hello?
Yes, sir.
Okay, good. I want to ensure that we are following. Ratio analysis. So the second aspect of it, the budgeting process from management accounting assists financial management function in strategic planning. I hope you also know the budgeting and the essence of the budget, which is just a plan for a particular period. Planning what should be done and what we expect to achieve. Then C, long-term investment appraisal is an aspect where both management, accounting, and financial management overlap. Long-term investment appraisal is where the management, accounting, and financial management overlap. Of course, I'm sure we must have heard of long-term investment, which is different from short-term investments. Management accounting provides information on inventory control, receivables, and other components of working capital. Financial accounting has the day-to-day obligation for trade receivables, while financial management is concerned with the efficient management of working capital. This implies that they all play a role in working capital management. I'm sure we must have heard of working capital also. We're just going through it since this is the introductory class. Now, financial objectives were 1.4. Every organization exists for a purpose. Objectives or targets explain what the organization is trying to achieve. Strategy is concerned with how the organization can achieve it. Objectives explain what the organization is trying to achieve. That's the objective. Now, the strategy is concerned on how the organization would achieve that objective that has been set. A corporate objective is the major purpose that an organization is trying to achieve. That's the corporate aim, not the individual aims or the departmental objectives. That corporate objective that has been set out is what the organization is trying to achieve. The main objective of a company might be to maximize the wealth of the company's owners, that's its equity shareholders, to either maximize their wealth. The main objective of a state-owned organization might be stated in terms of providing a certain standard of public service. I'm sure we know what state-owned organizations mean. So it's to achieve a certain standard for public service. Then the main objective of a charity will be to fulfill its charitable purpose. For example, provide maximum aid or support for a particular group or people. So we can see now, we've mentioned the main objective of a company, of a state-owned organization, and then of a charity. They all differ. But the financial management would help us to achieve all those aims. That's using the strategy we have set out. The main corporate objective might therefore be expressed as a financial objective with appropriate targets that can be measured. With appropriate targets, that's the emphasis there, that can be measured. A financial objective is a specific, measurable, achievable, relevant, and time-bound, and the acronym is SMART. Specific, measurable, achievable, relevant, and time-bound goal that an organization seeks to accomplish through financial management. At least I'm sure that we are familiar with this SMART acronym. When the main objective of an organization is not a financial objective, there is always a financial constraint on its objective, such as providing the highest quality of public service with the available finance. 1.5, strategic process. Plans or strategies are formulated for the achievement of the corporate objective. The process of formulating the strategy is as follows. 1, you identify the corporate objective using financial objective. 2, you establish the targets for the financial objective. 3, we develop the business strategies for achieving the financial objectives or targets. That target we have set. We have to develop the strategies, like we mentioned before. Then we convert the strategies into action plans and then monitor the performance. So if you have set the targets and you have not set out the strategies, you are still halfway. Then if you set out the strategies, it has to be converted to action plan, and then we monitor it. This implies that the identification of a primary objective is the starting point for the formulation of a strategy to achieve the objectives. Identifying the main financial objective. Shareholder wealth maximization is a fundamental principle of financial management. Shareholder wealth maximization. I hope we understand it. Shareholder wealth maximization. A financial objective can be expressed in several ways. Financial objectives include stakeholder value creation, shareholder wealth maximization, profit maximization, and earnings per share growth. Shareholder value creation, at least we understand that one. Shareholder wealth maximization, profit maximization, and earnings per share growth. 1.61, stakeholder value creation as a financial objective. This refers to the process of creating value for all stakeholders. Advocates of this objective believe that the competing claims of a wide range of stakeholders should be balanced by the organization while considering its economic and social responsibilities. This objective implies that the organization should be able to identify all its stakeholders and their interests, create a strategy to balance their various interests, especially where there may be conflicts. Just hold on, please. Advantages of stakeholders' value creation. I think there's echo somewhere. Okay, the advantages. It may lead to an improved reputation for the organization based on positive stakeholder experiences. It may create a stronger bond between the stakeholders, which may result in increased loyalty to the organization. That is when there's a strong bond between the stakeholders. Of course, it will result in increased loyalty. Unique stakeholder value propositions may give the organization a competitive advantage in strategic differentiation. D, it may lead to long-term sustainable growth as it encourages investment in human capital, innovation, and social responsibility. E, it could improve risk management by encouraging proactive management of social and environmental aspects and mitigating risks associated with stakeholder relationships. Challenges of stakeholder value creation. Class, I hope we are following. Hello?
Yes, sir.
I need your feedback. Okay. Challenges of stakeholders value creation. 1, how do we manage the conflicting demands and expectations from different stakeholder groups? 2, it may be difficult in practice to identify relevant metrics and indicators to measure stakeholder value creation. These are the challenges. C, unequal power distribution amongst the stakeholders would pose a significant challenge if this were taken as the primary objective. D, how do we address the global issues that affect stakeholders' value creation? E, it may be an issue trying to manage the trade-offs between the financial and non-financial objectives of stakeholders. And the last one, it will be a daunting task integrating stakeholder value creation into the strategy, operations, and culture of the organization. These are the challenges associated with stakeholders' value creation. Shareholders' wealth maximization as a financial objective. The main corporate objective can be stated as the maximization of shareholders' wealth, and this means maximizing the market value of the company. Most companies are owned by shareholders, and it is logical that the primary objective is to maximize their wealth. Of course, I'm sure we understand this one. Most companies are owned by shareholders, and in my local parlance, they say that he who pays the piper dictates the tune. Shareholder wealth is increased by dividend payments and a higher share price. Dividend payments and a higher share price. That's what increases the shareholders' wealth. Corporate strategies are therefore desirable if they result in higher dividends, higher share prices, or both. So either higher dividends is okay, higher share prices is also okay, but if we're able to achieve the two, then that's the best. Advantages of shareholders' wealth maximization. So what advantages do the shareholders get if their wealth is maximized? It provides a clear objective for the organization. It encourages effective allocation of resources to increase returns. It helps to ensure long-term viability of the organization. It helps to ensure that the organization is responsive to market demands and changes. And lastly, it supports long-term growth and sustainability. That's the advantages of shareholders' wealth maximization. Now, what are the challenges of shareholders' wealth maximization. What are the challenges? One, what should be the period for setting targets for wealth maximization? How will wealth creation be measured? That wealth that we have created, how do we measure it? How can targets be divided into targets for dividend payments and targets for share price growth? Remember those two factors we mentioned. So how can the targets be divided to achieve the two? Share prices are often affected by general stock market sentiments, and short-term increases or falls in share price might be caused by investor attitudes rather than any real success or falling of the company itself. The objective of maximizing shareholder wealth is generally accepted as a sound basis for financial planning. But it is not practical in terms of actual setting financial performance targets and measuring actual performance against the target. Other financial objectives such as profit maximization and growth in earnings per share might be used instead, on the expectation that it will increase shareholders' wealth. Some of these terms, we'll meet them in details later in this chapter, like this earnings per share. We'll do the arithmetical calculation or computation. So we get to profit maximization as a financial objective. This is the goal of an organization, earning the highest possible profits. The organization sets targets for profit growth over a strategic planning period. The organization is focused on increasing revenue, reducing costs, and ensuring efficient allocation of resources. I'm sure we understand this one. If you increase revenue and reduce costs, then of course, you will achieve efficient allocation of resources. Advantages of profit maximization. One, it provides a clear and simple objective for the organization. Two, it encourages organizations to allocate resources efficiently to maximize profit. Three, it simplifies measurement of performance in the organization, as profit maximization is easy to understand and measure. Four, it encourages a culture of competitiveness through innovation and continuous improvement. And then the last advantage, it increases returns to shareholders through dividend payments and capital appreciation. So what are the challenges of profit maximization? One, deciding the period over which the profit performance should be measured. There is a need to balance short-term with long-term issues, because it is possible to increase short-term profits at the expense of long-term profits. For example, a company might avoid replacing aging equipment to avoid higher depreciation, or might avoid investing in new projects that will make initial losses, regardless of how profitable they might be in the future. B, profits can be increased by raising and investing more capital. When share capital is increased, total profits might increase due to bigger investment, but the profit per share may fall. C, it may encourage short-term achievements or focus by the managers, partly because their remuneration might depend on meeting annual performance annual performance targets, or because the managers do not expect to remain in the same job for too long. D, accounting profit is different from cash flow, and so investors may be more interested in cash flow. Accounting profit is different from cash flow, so investors may be more interested in cash flow. It could lead to window dressing and other sharp practices to manipulate the profit. I'm sure we have heard the term window dressing before. Earnings per share, EPS growth as a financial objective. Earnings per share is a popular accepted measure of profit per share. The financial objective might be to increase the earnings per share each year and possibly to increase the earnings per share by a target amount each year for the next few years. It is calculated as profit after tax and preference dividends divided by the number of shares in issue. So this formula will still meet it again down the line, and then we'll use a practical example. Advantages of earnings per share growth. The growth in earnings per share target ensures that there will be more profits to pay the dividend per share. B, it ensures that there will be more retained profits to reinvest with the intention of increasing earnings per share more in the future. It will result in growth in shareholders' wealth over the long term. So what are the challenges of earnings per share growth? What are the challenges of earnings per share growth? Earnings per share can be increased through borrowing and debt capital through the tax relief on interest and not the performance of the company. B, however, higher financial gearing, the ratio of debt capital to total capital, can expose shareholders to greater financial risk. Because of higher gearing, the share price might fall even when earnings per share increases. C, it is a measure of profitability and is subject to the same challenges as profit maximization above. Please just hold on. Okay. The main points to note about a company's financial objective are: 1, financial performance is concerned with decisions on financing, investment, and dividend issues. It's concerned with decisions on financing, investment, and dividend issues. 2, financial management, though related, is different from financial accounting and management accounting. It is generally accepted that the main financial objective of a company should be to maximize or increase shareholders' wealth. 4, there are practical challenges in selecting a suitable measurement for growth in shareholders' wealth. Financial targets such as profit maximization and growth in earnings per share might be used, but no financial target on its own is ideal. No financial target on its own is ideal. Then the 5th main point to note about company's financial objective is financial performance is therefore evaluated in a number of ways, but the increase in share price, growth in profit, growth in earnings per share, and so on. So financial performance is evaluated in a number of ways, either by the increase in share price, growth in profit, or growth in earnings per share. Shareholders and their objectives. Corporate objectives and the influence of shareholders. Shareholders refer to everyone with a vested interest in the activities or performance of a company. Everyone with a vested interest in the activities or performance of a company. Although the theoretical objective of a private sector company might be to maximize the wealth of its owners or shareholders, other individuals and groups have an interest in what a company does, and they might be able to influence its corporate objectives. It is usual to group stakeholders into categories, with each category having its own interests and concerns. The main categories of stakeholders in a company are usually the following. So we'll run it down first. We have the shareholders, the directors and senior managers, other employees, lenders, the government, customers, suppliers, and society as a whole. So we have mentioned 8 now, 8 categories of stakeholders. So let's start with shareholders. The shareholders are stakeholders group. They are the stakeholders themselves. Their interest is to obtain a suitable return from their investment and to maximize their wealth. Some shareholders are long-term investors with an interest in long-term share price growth and dividends, while other shareholders might be short-term investors hoping for quick capital gain and or high short-term profit and dividends. The next set of stakeholders are the directors and senior managers. An organization is led by its board of directors and senior executive management. Their interest in the organization would be advancing their career, more income, good working conditions, and personal wealth. I'm sure that some of us fall into this category. Then the third group is other employees. The other employees in a company have a personal interest in what the company does. Their focus will be their salary or wages, job security, or career prospects. However, unlike directors and senior executives, other employees might have less influence on what the company does unless they have strong trade union representation or have some other source of power and influence, such as specialist skills that the company needs and relies on. The fourth stakeholder group are the lenders. Lenders. When a company borrows money, the lenders are stakeholders. Lenders might be banks or investors in the company's bond. The main concern for lenders is to protect their investment. If the company is heavily in debt, credit risk might be a problem, and lenders might be concerned about the ability of the company to meet its interest and principal repayment obligations. They might also want to ensure that the company does not continue to borrow even more money so that the credit risk increases further. The next set of stakeholders is the government. The government also has an interest in companies, especially large companies, for a variety of reasons, which include the government regulates commercial and industrial activity. Therefore, it has interest in companies as a regulator. That is their regulatory function, the regulatory function of the government. Of course, we know that every sector has a government agency that regulates it. For instance, the electricity in Nigeria here, there's a regulator for it. Then companies are an important source of taxation income for the government. Both tax on corporate profits and tax on employment income and sales tax. Of course, we know the various forms of taxes, even with this tax reform, which we are all learning. Everybody is learning it now. Companies are also employers. And one of the economic aims of the government might be to achieve full employment. And then the last, when it comes to government, is some companies are major suppliers to the government. So another set of stakeholders, remember that we are still discussing the stakeholders. We now have the customers. So who are the customers? Customers have an interest in the action of companies whose goods or services they buy and might be able to influence what companies do. Of course, there's this saying that the customer is the king, and no organization would like to lose a customer. That's why some major organizations establish the customer feedback. The next set of stakeholders are the suppliers. Major suppliers to a company might have some influence over its actions. Then the society as a whole. A company might need to consider the concerns of society about issues such as business ethics, human rights, the protection of the environment, the preservation of natural resources, and avoiding pollution. Companies might need to consider how to protect their reputation in the mind of the public, since a poor reputation might lead to public pressure from new legislation and as a loss in customer support for the company's products or services. Companies might therefore state the objectives in terms of seeking to increase the wealth of their shareholders, but subject to the need to satisfy other stakeholders. 2, rewarding employees well and being a good employer, acting ethically in business, and showing due concern for social and environmental issues. The ability of stakeholders to influence what a company does depends to a large extent on the extent to which their interests can be accommodated and do not conflict with each other, and the power of each group of stakeholders to determine or influence the company's objective and strategies. Now, are there conflicts between stakeholders' objectives? That's what we're going to look at now. Are there conflicts between different stakeholder objectives? Hello, class. I hope you're following.
Yes, we are with you, sir.
Yes.
Yeah, with you.
Yes,
All right,
sir.
thank you.
That we're supposed to ask, because we are too fast, we can't ask.
Sorry?
There are some places that we're supposed to ask you questions about something, but because it's like you are rushing the lecture a bit because of the time wasted. We understand that maybe for the next class it will be better for us to have an interactive session with you, sir.
Okay. So do we pause and take those questions, or do we take it at the end of the class?
Continue, sir.
Okay, I should continue. Thank you. Different stakeholders have different interests in a company, and this might be incompatible and in conflict with each other. When stakeholders have conflicting interests, either a compromise will be found so that the interests of each stakeholder group are satisfied partially, but not in full. Or the company will act in the interest of the most powerful stakeholder group so that the interests of the other stakeholder groups are ignored. In practice, there might be a combination of these two possible outcomes. A company might make small concessions to some stakeholder groups, but act mainly in the interest of its most powerful stakeholder groups. Of course, I'm sure that we understand this. In every group, there must be those that influence what is happening or decide what is happening. Some examples of conflicting interests of stakeholder groups are as follows. A, if a company needs to raise more long-term finance, its directors and shareholders might wish to do so by raising more debt capital, because debt capital is usually cheaper than equity finance. However, existing lenders might believe that the company should not borrow anymore without first increasing its equity capital by issuing more shares or retaining more profits. The terms of loan agreement, that's the lending covenants, might therefore include a specification that the company must not allow its debt level or gearing level to exceed a specified maximum amount. Another example is the government might want to receive a tax on a company's profit, whereas the company will want to minimize its tax liabilities through efficient tax avoidance schemes. I'm sure we must have had some of these terms before. You know, the government, of course, will always want to receive a higher tax. But through tax avoidance schemes, which is different from evasion. No, evasion is illegal. Then C, a company cannot maximize returns to its shareholders if it also seeks to maintain a contented workforce, possibly by paying them high wages and salaries. Of course, I'm sure we also understand this one now. Then D, a company cannot maximize short-term profit if it spends money on environmental protection measures and safe waste disposal measures. So whatever that makes the company to spend money will reflect on the stakeholders. However, the most significant conflict of interest between stakeholders in a large company, especially in a public company, where shares are traded on a stock market, is generally considered to be the conflict of interest between the shareholders and the board of directors. So these shareholders and board of directors, especially the executive directors and the other senior executive management. This perceived conflict of interest is fundamental to agency theory and the concept of good corporate governance that have developed from agency theory. So what is agency theory? Agency theory was developed by Jessen and Mecklings, 1976, who defined the agency relationship as a form of contract between a company's owners and its managers, where the owners appoint an agent, that's the manager, to manage the company on their behalf. As part of this arrangement, the owners must delegate decision-making authority to the managers. I'm sure we understand this one. Most companies, the owners are different from the managers, who are the agents. The owners expect the agent to act in the best interest of owners, as stated in the contract between them. However, it is impossible to arrange the perfect contract because decisions by the managers or agents affect their own personal interest as well as the interest of the owners. Managers will give priority to their personal interest over those of the shareholders. And when this happens, there is a weakness or failing on the governance of the company. I'm sure we understand it. We understand this one. Agency conflicts. I hope we understand this agency theory. Class?
Yes, sir.
Okay. Now, agency conflicts. Agency conflicts are differences in the interest of a company's owners and managers. They arise in several ways. So we'll run down through it. We'll just mention it before laying emphasis or discussing them one by one. So the several ways are moral hazards, effort level, earnings retention, risk aversion, time horizon. We've mentioned 5 of the several ways now. So moral hazard. A manager has an interest in receiving benefits from his or her position as a manager. These include all the benefits that come from status, such as company car, lunch, attendance at sponsored events, and so on. Jessen and Mecklin suggested that a manager's incentive to obtain these benefits is higher when he has no shares or only a few shares in the company. Large companies, of course, the managers are not part of the owners. They want more, or if their share is just small, they have just a little interest in the company. B, or the second conflict, effort level. Managers may work less hard than they would if they were the owners of the company. The effect of this lack of effort could be lower profits and a lower share price. The problem will exist in a large company at middle levels of management and senior management level. The interests of middle managers and the interests of senior managers might well be different, especially if senior management are given pay incentives to achieve higher profits, but the middle managers are not. Another conflict is the earnings retention. The remuneration of directors and senior managers is often related to the size of the company rather than its profits. This gives managers an incentive to grow the company and increase its sales turnover and assets rather than increase the returns to the company's shareholders. Management are more likely to want to reinvest profits in order to make the company bigger rather than pay out the profits as dividend. Risk aversion. Executive directors and senior managers usually earn most of their income from the company they work for. They are therefore interested in the stability of the company because this will protect their job and their future income. This means that management might be risk averse and reluctant to invest in higher risk projects. In contrast, shareholders might want a company to take bigger risks if the expected returns are sufficiently high. Depend on the expectation for the long-term future. In contrast, managers might only be interested in short-term. This is partly because they might not receive annual bonuses based on short-term performance, and partly because they might not expect to be with the company for more than a few years. Managers might therefore have an incentive to increase accounting return on capital employed or return on investment, whereas whereas shareholders have a greater interest in long-term share value. Agency costs. So what are the costs that the shareholders incur? Agency costs are the costs that the shareholders incur when professional managers run their company. Agency costs do not exist when the owners and managers are exactly the same individuals, like one-man businesses. Agency costs start to arise as soon as some of the shareholders are not also directors of the company. Agency costs are potentially very high in large companies where there are many different shareholders and a large professional management. There are three aspects to agency costs. They include the cost of monitoring. The company establishes systems for monitoring the action and performance of management to try to share that management are acting in their best interests, to try to ensure that management are acting in their best interests, please. An important example of monitoring is the requirement for the directors to present an annual report and audited accounts to the shareholders, setting out the financial performance and financial position of the company, preparing accounts and having them audited as a cost. Agency costs also include the cost to the shareholder that arise when the managers take decisions that are not in the best interest of the shareholders, but are in the interest of the managers themselves. Opportunity costs. For example, agency costs arise when a company's directors decide to acquire a new subsidiary and pay more for their position than it is worth. The managers will gain personally from the enhanced status of managing a larger group of companies. The cost to the shareholders comes from the fall in share price that will result from paying too much for the aspect of the agency cost is costs that might be incurred to provide incentives to managers to act in the best interest of the shareholders. These are sometimes called bonding costs. The main example of bonding costs are the cost of remuneration packages for senior executives. These costs are intended to reduce the size of the agency problem. Directors and other senior managers might be given incentives in the form of free shares in the company or share options. In addition, directors and senior managers might be paid cash bonuses if the company achieves certain financial targets. 1.9. So let us look at achieving stakeholders' objectives or reducing the agency problem. Achieving stakeholders' objectives or reducing the agency problem. Jason and Macklin argued that in order to reduce the agency problem, incentives should be provided to management to increase their willingness to take value maximizing decisions. In other words, to take decisions that benefit the shareholders by maximizing the value of their shares. Several methods of reducing the agency problem have been suggested, and these include, so what are the methods of reducing the agency problem? So we'll look at a number of them. A, devising a remuneration package for executive directors and senior managers that give them an incentive to act in the best interests of the shareholders. Farmer and Jensen 1983 argued that an effective board must consist largely of independent, non-executive directors Independent non-executive directors have no exclusive role in the company and are not full-time employees. They are able to act in the best interests of the shareholders. C. Independent non-executive directors should also take the decision where there is or could be a conflict of interest between executive directors and the best interest of the company. For example, non-executive directors should be responsible for the remuneration packages for executive directors and other senior managers. These ideas for reducing the agency problem are contained in codes of corporate governance, incentive schemes, or management reward schemes. Incentive schemes or management reward schemes. This chapter has so far made the point that the main objective of a company should be financial objective, but there are different ways of stating this objective and in measuring the extent to which the objective has been achieved. There are different stakeholder groups with an interest in a company, and these are likely to have conflicting interests. The main conflict of interest is the agency problem and the different interests of shareholders and senior executive managers and directors. This raises the question, can the agency problem be reduced? And can managers be persuaded to focus on returns to shareholders as the main objective of the company? Managers may be encouraged to work in the best interest of the company if there are remuneration incentive schemes or reward schemes linked to the profit, earnings, share price, or total shareholder return. I'm sure we understand in this aspect. Managers may be encouraged to work in the best interest of the company if there are remuneration incentive schemes or reward schemes that are linked to the profit, earnings, share price, or total shareholder returns. That's if a manager is sure that he will share from the profit or earnings, he will put in more effort. But if it is just whether he works or not, he will get his salary, then he may really not be encouraged to work in the best interests of the company. Most, if not all, large stock market companies have remuneration schemes for their executive directors and other senior managers, and the purpose of such schemes is to make the personal interest of the directors and managers similar to those of the shareholders by achieving financial performance that is in the interest of the shareholders, directors, and managers will also obtain personal benefits for themselves. Structure of a remuneration package for senior executives. What is the structure of remuneration package for senior executives? The structure of a remuneration package for executive directors or senior managers can vary, but it is usual for a remuneration package to have at least 3 elements. That's the basic salary with pension entitlement, the annual performance incentives, and the long-term performance incentives. So it's better for the remuneration to have these 3 aspects: the basic salary, the annual performance incentives, and the long-term performance incentives. Basic salary needs to be high enough to attract and retain individuals with the required skills and talent. Annual performance incentives, where the reward is based on achieving or exceeding specified annual performance targets. The performance target might be stated as profit or earnings growth, earnings per share growth, achieving a profit target, or achieving a target for the TSR. Some managers might also have a non-financial performance target. For some managers, Some managers might have several annual performance targets. There is a reward for achieving each separate target. Annual rewards are usually in form of a cash bonus, long-term performance incentives, which are linked in some way to share price growth or TSR over a longer period of time. In practice, typically 3 years. Long-term incentives are usually provided in the form of share awards or share option in the company. The purpose of these awards is to give the manager a personal incentive in trying to increase the value of the company's shares. As a holder of shares or share options, the manager will benefit financially from a rising share price. Remember, we have looked at the incentive scheme. We have looked at the structure of the remuneration. Now let's look at the share awards. With a share award scheme, the company purchases a quantity of its own shares and awards these to its executive directors and other senior managers on condition that certain long-term financial targets are achieved, typically over a 3-year period. Share options. A company might award share options to its executives. A share option gives its shareholder the right to purchase new shares in the company on or after a specified date in the future, typically from 3 years after the options have been awarded. The right to buy new shares in the company is at a fixed price, an exercise price that is specified when the share options are awarded. Typically, the exercise price is the market price of the shares at the time the options are awarded. The holder of a share option gains from an increase in the share price above the exercise price and so has a direct personal interest in a rising share price. For example, a company might award share options to its chief executive officer. If the market price of the shares at the date of the award is 7 naira, for example, the CEO might be given 500,000 share options at 7 naira per share, exercisable from 3 years after the date of the option. Price 3 years later is 10 naira, for example. The CEO will be able to buy 500,000 new shares at 7 naira and sell them immediately at 10 naira to make a personal financial gain of 1,500,000 naira. I hope we are following.
We are with you, sir.
Hello? Okay. Then, regulatory requirements as an approach to achieving stakeholder objectives. We have corporate governance, elements of corporate governance, steps taken by corporate governance to reduce agency problems, stock exchange listing practices. So we'll go through, we'll discuss them one by one. Regulatory requirements as an approach to achieving stakeholder objectives. Corporate governance. Corporate governance is a term that describes the way a company is managed on behalf of its owners by the board of directors. It is a more extensive approach to reducing the agency problem and trying to ensure that companies are governed in the best interests of shareholders. 2 elements of corporate governance. Remuneration and management.
Please, the facilitator should scroll up. We are not
Rewarding.
seeing the material. You should scroll up.
Hello?
It's good. It's
Hello?
okay now. Yeah, it's okay now, sir. It's okay.
Continue, sir.
Are you seeing it now?
Yeah, very well, very well. I'm seeing
Yes,
it now.
yes,
You can
sir.
continue.
Okay. Okay, so I can continue.
Yeah, sure, sir. Continue.
Can I continue?
Continue,
Yes, sir.
sir.
Yes, sir.
Yes, sir.
Hello?
Continue,
Okay.
So
sir.
you can go ahead.
Elements of corporate governance. Okay. Remuneration and management reward schemes are one aspect of corporate governance, but there are others, and they include the board of directors, responsibilities and composition of the board of directors, the remuneration for directors, internal control and risk management, external auditors, financial reporting and independence, and communication between the company and its shareholders, and the rights and responsibilities of shareholders. Steps taken by corporate governance to reduce agency problem. So we look at the board responsibilities, the board composition, the board committees, the external auditors, and others. So A, what are the steps taken by corporate governance to reduce agency problems? Board responsibilities, that's number one. The board of directors should, in their responsibilities, reserve certain decisions about major strategic investments to the board as a whole. The essence of this is to ensure that major decisions are taken by all directors and not just executive management. You reserve some responsibilities for the interests of the organization. Then B, board composition. The positions of the chairman and the chief executive officer should not be held by the same individual. This is to avoid exerting excessive influence. This is part of division of labor. Then C, at least half the board, excluding the chairman, should be independent non-executive directors. This is to ensure that there are individuals in the board who do not have a conflict of interest and would work in the best interests of shareholders. Board committees. It insists that there should be at least 3 committees of the board, such as nominations, committees to appoint directors, audit committee to liaise with external auditors, and remunerations committee to negotiate the remuneration of individual directors. So at least 3 committees of the board, such as the nomination committees, the audit committee, and then the remuneration committee. External auditors. The external auditors. Stock exchange listing practices. The stock exchange rules help ensure that public companies are managed in the best interests of shareholders and the agency problem reduced. They include financial statements, quarterly and annual returns, and then the last one, that the report should be submitted within a particular period. So what are financial statements? These are publicly listed companies in Nigeria are required to submit their financial statements regularly. That's part of the stock exchange listing practices. Quarterly and annual reports. Companies must prepare and submit both quarterly and annual reports to update shareholders on their performance. And then these reports must be submitted within the required time frame or face penalties. Evaluating the achievement of corporate finance objectives. When a financial objective is established, actual performance should be measured against the objective. This requires the calculation of one or more suitable performance requirements. Financial objectives are commonly measured using ratio analysis. Financial ratios can be used to make comparisons, and these might be Comparison over a number of years by looking at the ratios of a company over a number of years, it might be possible to detect improvements or deterioration in the financial performance or financial position of the entity. Ratios can therefore be used to make comparison over time and to identify changes or trends. Comparison with the similar ratios of other similar companies for the same period. That is, you can also compare with other companies for the same period. You can also compare with industry average ratios. So you can do year on year, you can do with other companies, and you can also do with industry average ratios. Now let us look at the return on capital employed. Return on capital employed. Profit-making companies should try to make a profit that is large enough in relation to the amount of money or capital invested in the business. The most important profitability ratio is return on capital employed, or ROCE. Return on capital employed, ROCE. The formula for return on capital employed is profit before interest and tax divided by share capital and reserve plus long-term capital plus preference share, all multiplied by 100%. The capital employed is the share capital and reserves plus long-term debt capital, such as bank loans, bonds, and loan stock. Where possible, use the average capital employed during the year. This is usually the average of the capital employed at the beginning of the year and end of the year. So we'll look at one example. Return on capital employed. ABC company achieved the following results in year 20x5. So you have the column for at the beginning of the year, which is 1st January, and then at the end of the year, which is 31st December of the same year, 20x5. And then you have the share capital of 1 naira. So at the beginning of the year, you have 1 million, and at the end of the year, 1 million. The share premium at the beginning of the year is 500,000, and it's still the same 500,000 at the end of the year. Accumulated profits at the beginning of the year is 2,500,000 naira, while at the end of the year is 3 million naira. Bank loans at the beginning of the year is 1 million, while at the end of the year is 2,500,000. So we have the total at the beginning of the year to be 5 million, while the total at the end of the year is 7 million naira. Then we look at the profit before taxation, which is 1,050,000 naira. We have taxation 375,000. When you deduct the taxation from that profit before taxation, you now have 675,000 naira. Then there's additional note. Interest charges on bank loans were 150,000 naira. Sales during the year were 29 million naira, and dividend payment to shareholders were 225,000 naira. So what are we required to do? We are required to calculate the return on capital employed for the year 20x5. So we'll look at the solution to the example above. Of course, we already know the formula that return on capital employed is the profit before taxes divided by average capital employed times 100. That makes it 100, that's percent. And then from the solution, profit before taxation is 1,050,000, while the interest is 150,000 naira. So when you add the two, it gives you 1,200,000. That's the profit before interest and taxes. Then for the denominator, you have the average capital employed. average capital employed, you can see that the capital at the beginning of the year is 5 million, while the capital at the end of the year is 7 million. When you add the two, it gives you 12 million naira, and then you divide it by 2, it gives you 6 million naira. So when you now divide the 1,200,000 by the 6 million naira and multiply by 100%, it gives you 20%. Is this clear? Hello, class.
Your screen has stopped showing, but we can get you from the audio.
Oh, on the audio. Okay. Okay, let's continue. The return on capital employed figure can be compared to the return on capital employed achieved by the company in previous years, or the return on capital employed of similar companies, especially competitors. So that's a comparison that shows you whether you are doing very well or not. When you compare it, when you compare year on year, or when you compare with similar companies, especially the competitors. The sales and dividend payments were not relevant in solving this question because we were given the profit and capital employed at the end of the year. So let's look at return on equity. We have just discussed return on capital employed. So we'll look at the return on equity. Return on equity, ROE, measures the return on investment that the shareholders of the company have made. This ratio normally uses the values of the shareholders' investment as shown in the statement of financial position rather than the market values of the shares. Return on equity, the formula is profit after taxation and preference dividend divided by share capital and reserves, all multiplied by 100%. Profit after taxation and preference dividend divided by share capital and reserves, all multiplied by 100%. The average value of shareholder capital should be used if possible as the average. This is the average of the shareholder capital at the beginning and the end of the year. Profit after tax is used as the most suitable measure of return for the shareholders. Since this is a measure of earnings available for payment as dividends or for reinvestment in the business. So we'll look at an example now, and we're using the same data that we use for the return on capital employed. We use the same data. So to compute the return on equity, we state the formula first, profit after tax divided by average shareholders capital times 100%. So the profit after tax from that table is 675,000 divided by the average shareholders capital, which is 4,250,000 multiplied by 100%. I'm sure we.
I don't understand, please. Can you go back again?
Okay. The return on equity. The formula is profit after tax. And from the table, the profit after tax is there. It's stated there as 675,000. Then divided by average shareholders capital. Now, what is the average shareholders capital? I think that may be where you, if you Okay, you are not seeing the screen. All the same. But the shareholders' capital at the beginning of the year is 4 million. So if you go to that table, you see the bank loan. Just remove the bank loan from the 5 million. It gives you 4 million. And this is 4 million at the beginning of the year. So at the end of the year, the bank loans amounted to 2,500,000. So once it's removed from that 7 million, it gives you the 4,250,000, the 4,500,000. Sorry. So when you add the two, the 4 million at the beginning plus the 4,500,000 at the end, it gives you 8,500,000. When it's divided by 2, just to find the average, it gives us 4,250,000. So by the time you multiply it by 100, we now get 15.88%. Is it clear now?
Yes, sir.
Okay, thank you. So we go on to earnings per share and dividends per share. Earnings per share and dividends per share. The earnings per share EPS is a measure of the profit after taxation and preference share dividend, if any, per equity share during the course of a financial year. The earnings per share might be 1, historical earnings per share as reported in the company's financial statement, or B, a forward-looking earnings per share, which is the earnings per share that the company expects to achieve in the future, usually in the next financial year. So it can be historical, or it can be the one that the company is looking forward to achieving. Dividend per share might be important for shareholders who are seeking income from shares rather than capital growth. The company may have a dividend policy which aims for steady growth of dividend per share. The formula for basic earnings per share. We have the net profit or loss attributable to ordinary shareholders during a period divided by the weighted average number of shares in issue during the period. The formula again for earnings per share. Net profit or loss attributable to ordinary shareholders during a period divided by weighted average number of shares in issue during the period. So using the same table that we have used for the return on capital employed, which we also use for the return on equity, we now want to use it for earnings per share. It's the same data. So we're required to calculate the earnings per share and the dividend per share for year 20x5. Earnings per share equals profit after tax divided by number of ordinary shares. And from the table, we can see that the last data there is that profit after tax, which is 635,000 divided by the number of ordinary shares. And the number of ordinary shares, you can see that's the first data on that table, because the company has share capital of 1 naira and has a value of 1 million naira. So the number of ordinary shares is 1 million. If you now divide the 675,000 by the 1 million, you get 67.5 kobo per share. Then the dividend per share is total dividend divided by the number of ordinary shares. And what is the total dividend? Of course, it's also given as additional information that the dividend payment to shareholders were 225,000. So we now divide it by the number of ordinary shares again, which is 1 million, and you get 22.5 kobo per share. Is this clear enough? Hello, class. Hello?
Yes, sir.
Wow. Okay,
Yes,
okay,
sir.
okay, thank you. Thank you very much. So changes in share price and dividend. Changes in share price and dividend. Financial performance can also be measured by the return provided to shareholders over a period of time, such as financial year. The total return consists of dividend payments plus the increase in share price during the period, or minus the fall in share price. This total return, often called total shareholders return, TSR, total shareholder return, total shareholders returns, TSR. I'm sure we have mentioned it somewhere at the beginning, can be expressed as a percentage of the value of the shares at the beginning of the period. Total shareholders return can be expressed as a percentage of the value of the shares at the beginning. Example, on 1st January 20X5, the share price of ABC Limited was 15 Naira per share. During the year, dividend of 75 kobo per share were paid. And on 31st December 20X5, the share price was 17.25 kobo per share. You are required to calculate the total shareholders return, TSR. Calculate the total shareholders return. Now, the formula for total shareholders return is price at end minus price at start plus dividend, all divided by price at start. That's price at the beginning of the period. We'll take it again. Total shareholders return, TSR. The formula is price at end minus price at start plus the dividend, all divided by price at start. So the price at the end, can you see the screen?
Yes, we can see it.
Yes, we can see it.
Okay, so what's the price? Okay, so what's the price at the end? At the end of that period, what's the price?
17 Naira 25 kobo. Price 17 Naira 25
What's the
kobo.
price?
17 Naira 25 kobo.
Good, 17 Naira 25. Good, good, thank you. I want to ensure that we are all following. So the price at the end, which is 17 Naira 25 kobo, minus the price at the start, which is 15 Naira. It gives you 2 Naira 25 kobo. Then you now add it to the 75 kobo, which is the dividend. It's also given in the question. Then divide by 15. That's the 15 Naira. That's the price at start. So 17.25 minus 15, that's 2.25 plus 0.75 gives you 3 Naira divided by 15 Naira. And this gives us 20%. I hope this is clear enough.
Yes, sir.
Okay, thank you. The total shareholders return can also be broken down into the capital gain yield and dividend yield. Capital gain yield equals price at end minus price at start divided by price at start. So you apply the same data. Price at end is 17.25. less 15 naira, all divided by 15 naira, and it gives us 15%. While the dividend yield is dividend divided by price at start, and the dividend is 75 kobo divided by the price at start, which is 15 naira, and it gives us 5%. So the total shareholders return equals capital gain yield plus dividend yield, which is 15% plus 5%, and it gives us that 20% we got with the first formula.
Okay.
I hope this is clear.
Two formulas to calculate the TSR.
Sorry?
I said two formulas, two ways to calculate the TSR.
Yes, you can use the first one, or it can be broken down into capital gains yield and dividend yield. So by the time you now get the capital gains yield and dividend yield, you add the two together, it gives you the same total shareholders return. So you can either use the first method or the second one, but the second one is broken down into two.
Thank you, sir.
To two elements, which is the capital yield and the dividend yield. Okay, thank you. So financial management in non-profit organizations. Financial management in non-profit organizations. Non-profit organizations are entities whose main objective is not financial. It is an entity that operates for the public benefit rather than to generate profit for shareholders or owners. The primary objective of a non-profit organization or an NPO is to address social, economic, or environmental issues rather than to maximize profits. Its major objective is not to make money, but to benefit prescribed groups of people. So, of course, from the name non-profit organization, understand it. They include charity organizations, foundations, advocacy groups, community organizations, and government departments and agencies. Every not-for-profit organization has a major objective. The main objective will be for the schools and universities to provide education in an education system, or provision of health care in the health service, or providing special aid and support for charities. The likely objectives of non-profit organization could also be, we have a data here in tabular form. Number one, social objective, improve the quality of life or address social issues like poverty. Number two, environmental objectives, protect and preserve the natural environment, climate change, and others. Number three category, research and development objective, conduct research and development in specific fields. Number four, educational objectives, provide education and training to individuals or groups. Number five, health objective, improve access to health care services. So of course, I'm sure the categories explain themselves. Health objective, educational objective, research and development, environmental objectives, and social objectives. Non-profit organizations have a major financial objective, but not-for-profit organizations need to have financial objectives and financial management to help them achieve their main objective. Some reasons why they need financial management include they need to survive. That's one. Two, they need to budget and plan their spendings. Three, they need to compare actual expenditure against budget. Four, their spending should not exceed the amount of funds available. Five, they need to monitor how efficiently they are using the available resources. Six, they need to ensure that the available funds are well utilized. And the last, they need to measure how well they are performing in relation to key objectives. So that's why they need financial management. Hello?
Please scroll up the
Hello?
screen. Scroll it up, sir. The screen, scroll it up.
Hello? Did anyone ask a question?
Yes, the material. Please scroll it up.
Okay. Okay, do I continue? Hello, do I continue?
Please, the material, sir. Please scroll the material so that we can see what's under.
Okay. Someone is helping us share the screen.
Okay, the person should scroll up.
Hello? Has the person scrolled up?
Yes, but it is not clear. I think it's the network, but the screen is already scrolled up.
It's network. Okay. Value for money. Value for money. Value for money is to not-for-profit organization what profit is to the financial management of companies. Value for money refers to the optimal use of resources to achieve the best intended outcomes subject to the cost incurred. It simply means getting the best possible outcome for the lowest possible cost. It is of the view that not-for-profit organizations should optimize available spending. Value for money has three elements, sometimes known as drivers of the value for money, or the 3 E's, which is economy, efficiency, effectiveness. Economy, efficiency, effectiveness, the 3 E's. Economy refers to minimizing costs while maintaining quality. You minimize costs while maintaining quality. It means obtaining the appropriate quantity and quality of resources at the lowest cost possible.
Screen now.
Can
Can you see it now?
Hello?
Can you see the screen now?
Yes, we can. Oh, it has gone off again.
Mute yourself, please.
Now, can you see the screen now? Yeah, it's okay like this. It's okay.
Okay. Okay, so I can continue. So we're looking at the 3 E's and we have discussed the economy. The second E is efficiency. Please mute yourself if you're not talking. Please mute yourself, please. Efficiency involves using resources the best way possible to get the most out of them. It is focused on maximizing outputs or outcomes while minimizing inputs or resources. Then the third E is effectiveness, which means achieving the desired outcomes or results. It is the relationship between the organization's intended and actual results. The relationship between intended and actual results, effectiveness. For example, one of the indicators to measure tuition house performance is exam results. Do you agree with this?
Yes,
Hello?
sir.
One of the indicators to measure tuition house performance is exam results. Effectiveness would be concerned with if the candidate passed the exam. And I'm sure by God's grace, all of us will pass. But we have to read it though. So we look at the three again: economy, efficiency, and effectiveness. Economy, efficiency, and effectiveness. So economy are the appropriate quantity and quality of input brought at the lowest cost. Appropriate quantity and quality of input brought at the lowest cost. Efficiency is how well the inputs or resources used converted into outputs. That's efficiency, how we've converted those inputs to outputs. And then effectiveness is how well do these outputs achieve the objectives. Achieving goals is the key issue. So the outputs achieve the predetermined objectives. So cost of the input is the key issue. Output per unit of input is the key issue in the efficiency ratio of output to input, while achieving the goals is the key issue in effectiveness. So cost of the input is the key in economy. Output per unit of input is the key for efficiency, while achieving the goal is the key for effectiveness. Value for money is seen as an appropriate framework for measuring performance in not-for-profit organizations because it reflects both the cost of providing a service and the benefits achieved by providing it. Examples. So we look at an example for value for money. In Abuja, a city in Nigeria, there are two major tuition houses. We have the ABC and the TBK. So here is stated XYZ. The number of teachers in the first class is 10. The number of teachers in the second tuition house is 10 also. The salary paid to teachers is 1 million in the first tuition house, while the salary paid to the teachers in second class is 1.5 million. Candidates pass ratio. In the first tuition house, you have 50%. In the second tuition house, you have 70%. Number of students in the first tuition house is 500, while the number of students in the second tuition house is 400. All teachers in Abuja have the same qualification and experience. Now you are required, using your understanding of value for money, evaluate the performance of A, B, C, and XYZ tuition houses, using your understanding of value for money. Now let's discuss the solution. Economy looks at costs. So ABC spends less than XYZ. So as ABC is spending 1 million, XYZ is spending 1.5. And it's more economical since the teachers are of same qualification and experience. Efficiency looks at the relationship between input and output. They both use 10 teachers, but ABC has been able to attract more students and has a lower staff cost per student. ABC is more efficient. ABC attracted more students and has a lower staff cost per student. Effectiveness looks at the intended goal, which in this case will be the pass rate of students. So XYZ has a higher pass rate percentage and is assumed to be more efficient. Do we understand this?
Yes, sir.
Okay, thank you. So we look at measuring the achievement of objectives in a non-for-profit organization. Difficulties in measuring achievement in a non-for-profit organization. These can be very complicated tasks. Measuring the achievement of objectives for the following reasons. A, there are different powerful stakeholder groups and not shareholders as in companies. Two, they usually have multiple objectives, and so it is difficult identifying the single major objective. It may be difficult to define targets that are clearly linked to objectives which are measurable. And then limitation of funding could restrict achievable objectives. So let's look at the methods of measuring achievement in a non-for-profit organization. Methods of measuring achievements in a not-for-profit organization. A, targets can be set for both financial and non-financial performance. B, benchmarking can be used where comparisons are made with other similar organizations and best practices. And C, budgeting could be used for planning and monitoring expenditure. Budgeting could be used for planning and monitoring expenditure. So we have come to the end of this chapter. If we do chapter review, we have explained the nature and purpose of financial management. We have distinguished between financial management, financial accounting, and management accounting. C, we have identified and described various financial objectives, which include stakeholders' value creation, shareholder value maximization, profit maximization, and earnings per share growth. I think we can stop here for today and take our questions. Are you there?
Yes, sir.
Yes, sir. Yes.
Hello?
We're here,
Yes,
Hello?
sir.
sir. We can hear you.
Hello?
We can hear you, sir.
Can you hear me?
Yes, sir.
We can hear you, sir.
Okay. We can stop here for today so that we take questions, if any. This is the first class, and I expected it. Of course, by the next class, there will be improvement. So let's take questions, if any.
Okay, sir.
Okay. Go ahead if you have one. I wanted to ask under
Hello, go
stakeholders
ahead.
and their objectives. Under stakeholders and their objectives, the E, lenders. You sorry. Let me scroll this again. The D, they're saying something about the last, towards the last line, that they might also want to ensure that the company does not continue to borrow.
Under stakeholders and objectives.
Yes, the lender, D, lenders.
Go on.
The last line, paragraph, you said they might also want to ensure that the company does not continue to borrow even more money so that the credit risk increases further, or so that the credit risk will not increase further. I want you to throw more light on that, sir. Is it that the credit risk should increase or it should not increase more than what it is already? Are you getting me, sir? That's all. It's off network.
Lenders.
Yes, sir.
Okay, the last line on
paragraph.
lenders.
Yes. It says that they might also want to ensure that the company does not continue to borrow even more money. Is it so that the credit risk increases further, or it might not increase further?
They might also want to ensure that the company they might also want to ensure that the company does not continue to borrow. Yes, I think I got you, but let's just go through it. Yes, what is credit risk? That's the question. The more you borrow now, the higher the risk.
Yes, I understand that, sir.
They might also want to ensure that the company does not continue to borrow, because the more you borrow now, the more the risk. I don't know. Is it understood now?
I'm trying to
the more you
get
borrow,
that last part. When a company borrows,
the more
you borrow, the more your credit risk increase. But now, in trying to ensure that the company does not borrow, is it to increase the risk or to make sure that the credit risk does not increase? That's what I'm trying to get there. That it does not increase further, or that it increases further.
Hold on. Let's just read it again. Listen. They might also want to ensure that the company does not continue to borrow, so that the credit risk increases. That is, the more you borrow, the more the risk. So if you do not borrow more, then the risk reduces. So
that's what
they
I
want to ensure that hello?
I can hear you, sir.
That is, the more you borrow, the higher the risk. So to ensure that the risk reduces, why not stop borrowing? At least let's leave it at where it is. That is, let's assume that we have borrowed, let's say 10 million, for instance.
Yes, sir.
They want you not to borrow the more. At least let us keep this risk at 10 million. Because if you ask for additional 5 million, it becomes 15 million. And at that 15 million, the risk has increased.
Order. Thank you, sir. I understand you.
Okay, you understand it now. Thank you.
I understand you very well. It's just the words that were used there. I was thinking that the line was not properly stated. Well, that's why I'm asking.
No.
Thank you, sir.
Okay. We have another question. Hello, do we have another question? Or do we call it a day? I need your response. Do we call it a day here?
For me, thank you, sir. I really enjoyed the class towards the end. At the beginning, it was somehow, but towards the middle part to the end, I enjoyed the class. I don't know for others.
That's the teaching problem, and we overcame the teaching problem.
Yes.
Thank you. Thank you.
Somehow.
Thank you, sir.
Okay. So
I think there's no.
We can. Good. So since we don't have questions again, I thank you for your patience. I thank you for giving us the opportunity to discuss it, because we're actually discussing it. We're learning every day. I'm also a student. I'm sure by the time we get to other topics now, you'll be the one teaching me, because it will be interactive.
Hello, sir.
Yeah,
Hello,
yes.
sir.
Yes, go on.
Sorry, hello, can you hear me?
Yes,
Can you hear me?
yes, very well.
Okay, sir. I just wanted to get further clarity on the influence of a lender when it comes to them requesting that more money should not be borrowed. At what level do they have influence in an organization? Because they are giving the organization money, and to protect their interests, they are now coming up to say, oh, more money should not be borrowed, so that the organization cannot be exposed to risks.
It's
So
cracking.
at what level?
It's cracking over here. Just go through it.
Okay, can you hear me now? Hello?
Yes, just
Wow.
start from the beginning. Yes, go ahead.
Okay,
Go ahead. Start from the beginning.
Okay, can you hear me now? Wow. Hello?
It's like he's having network issue.
Well, can you hear me now?
Yes, go on. I can hear you. Yes.
Okay, I just need clarity.
Yes.
Because the other participant asked a question that has to do with lenders. When it comes to protecting their own interests, ensuring that more money is not borrowed, so that the organization cannot be exposed to further risks. So my question now is, at what level or what influence does a lender have to come up with that
And what's the
decision?
I'm not sure I got the question. I heard you say that when it comes to lenders, that they want to ensure that more monies are not borrowed. But I didn't now get the question or what you want to understand. If you can hear
Okay,
me.
my question now is, can you hear me? Wow. Can you hear me?
He's having
Hello?
network issue.
Wow. Hello? Bad
Network
network.
is going off and on. I think what you are trying to ask is, at what level is the influence of the lenders on the companies not to borrow more?
What influence does a lender have? Is it your question?
Yes, over the
Because
company.
it's cracking. I don't know whether
Yes,
other
yes,
students had you very well. It's
yes,
cracking
that
from
is
this
what he's
end.
asking. That is what he is asking. At what level is the influence of the lenders on the company not to borrow more? At what level?
I didn't really get if other students understood you, let one of us just. Yes, I
Hello.
can hear you now.
I said what he was asking is, at what level?
What? Just repeat it. What?
At what level does a lender have over the company not to borrow more?
Okay. The influence of the lenders on the company not to borrow more. That
Yes,
is,
at what level is
at
that?
what
That's
point would the lenders say they don't want you to
borrow more? Yes.
I just hope that I understand what you are saying. But of course, lenders, if you expect me to tell you at maybe 80% or 100%, I may.
Hello?
But do you understand is that not the question you were trying to ask him?
Hello, can you hear me now?
I can hear you. The question
Okay,
you were trying to ask him
I
is
was
about the
trying to ask,
influence. At what point, Abi?
because
Okay, can I say something to you? Hello? Hello? Mr. Ayaka, can you hear me? Hello? Can we call it a day? Like network is very, very bad.
Okay, we can actually call it a day. I think you should keep your question for the next class.
It's him. It's Mr. Ayaka. I know what he was trying to ask the tutor is that at what point does the influence of the lenders come into the company not to borrow more? He's already stated in that place that no company will want to lose their money. If the debt of a company increases more, they will be afraid to borrow more to them because why? The ability of that company to pay, if the company goes bankrupt, it will be a problem. So no company will want to borrow out money again when they see that your debt profile is on the increase. So that the tutor had issues with the network, and him too is having network issue. So in the next time, I believe he can bring up that question so that the tutor can answer him properly. Okay, Ms. Blessing, let's call it a day.
All right.